A U.S. company pays a contractor in Colombia $8,400. By the time it lands, the contractor has $7,950 in his account. It wasn't a scam, it was a wire transfer. If you run a business that pays contractors, suppliers, or partners anywhere in Latin America, such as in Mexico, Colombia, Brazil, or Argentina, that 450 gap is happening with every transfer, and many businesses just resign themselves that it's a cost of doing business. Today, I'm breaking down how stablecoins are quietly overhauling that entire system, what's actually legal, what's not, and how to set it up correctly. I'm Ari Good, a United States licensed attorney focused on crypto regulation and cross-border payments, and this is the first in my two-part series on international stablecoin payments. So with that, let's get into it and where that 450 actually went. A traditional international wire isn't a direct transfer, it's more of a relay race. Your bank hands it to a correspondent bank, which hands it to another correspondent bank, which hands it to the recipient's bank. Each bank takes a cut, adds a delay, or quietly applies its own exchange rate. For a business paying a contractor in, say, Bogota or São Paulo, that means fees can run between 3 to 7% of the transfer amount, with settlement times of at least 2 to 5 business days, and that's if there are no compliance snags or technical failures along the way. Add in a week's worth of exchange rate exposure, and you have to start to admire their business model. They get the fees, you take the risk. In other words, if you're moving money regularly to Latin America, you're paying an inconvenience tax that really starts to add up. So what's the solution? Enter stablecoins. Stablecoins, or as they're referred to under the Genius Act, payment stablecoins, change the equation. A stablecoin is just a digital token that is typically pegged one-to-one to the United States dollar. Holders can transfer each other's stablecoins using blockchain rails. As of today, the lion's share of stablecoin transactions happen over Tron, Solana, and Ethereum, each of which has its own slight advantages and disadvantages. There are two types of stablecoin transfers. The first type is a direct transfer. A Colombian company, for example, sells fresh-cut, long-stemmed roses to a buyer in Virginia. Each party has its own crypto wallet that supports stablecoins. The buyer opens his crypto wallet, say MetaMask, and sends stablecoins over the Ethereum network to the Colombian seller who's using, say, Trust Wallet. The seller opens her wallet and sees the money come in. It's elegant, it's fast, and costs almost nothing. No relay race, no correspondent banks, no multi-day settlement. This was the original promise of crypto, but there's just one small thing. What happens when the payment lands? Our seller will need to convert her stablecoins to pesos using a local OTC desk or an online exchange connected to her bank account. These are typically regulated institutions who monitor transactions and run sanctions and other KYC checks against our seller. This phase, going from the crypto world back into the fiat world, is known as off-ramping. So the question, is it legal to send stablecoins internationally, and the question, am I doing it correctly, are two completely different matters. Yes, it is legal to send stablecoins as we did in our roses example. The rub is whether you are doing your off-ramping correctly. Remember our bank wire example? Well, for all the pain it caused, there were some important things going on behind the scenes. The first is compliance related. The bank you sent the wire from reviewed your account when you first set it up for fraud and sanctions violations, which of course came back clean. Second are the tax considerations. Fiat transfers do not generate tax consequences by themselves since fiat money is legally currency. But sending crypto, which in most countries is legally considered property, can get the tax man's attention. The buyer's flower payment may have been fast, but does he know where to look for the records at tax time? Maybe, maybe not. The third issue relates to transaction monitoring. With a wire, your bank runs a check against the recipient and her account. In some jurisdictions, the travel rule, just as one example, requires that you know who you're sending money to, even for small transfers. The bank has that check baked in. A direct crypto payment does not. That doesn't mean that this compliance obligation has gone away, rather it has shifted to you. Fourth, let's talk accounting and record-keeping, everybody's favorite topics. You don't want to end up at the end of the year with a stack of transfers you can't explain or trace. The tools are out there to do all of this work, but they require knowledge and time to learn and use. So, which way to go in international payments? Here is where we come to the second of the two ways to leverage stablecoins. I call this second method the hybrid approach, which requires 3 unique steps. Step 1. Choose the right on-ramp, stablecoin, and off-ramp solution for each recipient's country. This isn't a one-size-fits-all approach. Exchange rates and currency volatility vary considerably between, say, Mexico and Brazil, so the right setup for a contractor in one country may not be the right setup for another. Step 2. Document the process internally. Who initiates the payment, how is it recorded, and critically, how are you capturing exchange rates and fees at the exact moment the transaction occurs. One single document in this regard can make the difference between a clean tax filing and a complicated one. Step 3. Review these processes regularly. Don't just set it and forget it. Stablecoin regulation throughout the region, including through frameworks like the Genius Act and otherwise, are still actively developing. A setup that's compliant today should be reviewed as the rules evolve. I recommend that you audit your processes at least yearly. The idea is not to do things in the way that's most complicated, it's to be intentional and organized. The businesses that will realize the full benefit of stablecoin payments are the ones that bake compliance and record-keeping into the process from the start. But listen, maybe at this point you have a headache from all this and are just ready to capitulate and give up that 7% of every payment and wait a week for that wire transfer. Fear not, for there are solutions out there. A wave of very innovative fintechs have emerged over the past few years that specialize in cross-border payments. These companies have boxed the on-ramping, the stablecoin transfer backbone, and the off-ramping into done-for-you solutions. A little slower than crypto to crypto, but without the compliance, administrative, and record-keeping headaches. In part 2 of this series, I'm going to break down the best of these companies, so if you're ready to do business in the Americas, do not miss part 2. Or get in touch with me now, and I can help accelerate your time to market with the right partners. I'm Ari Good, blockchain lawyer. Thanks for watching.